So yeah, thanks everyone for being here. You're also seeing TJ. Give me one sec about it. So this will be better. And maybe TJ, if you could start sharing the slides right away, I think that would be good. And then we can yeah, have a lovely hour.
Let me bring them up.
Okay, perfect. Welcome everyone. Well, my name is Peter, running Compounding Quality. Maybe also for smooth collaboration here. Let's put everyone on mute. We will do a 1 hour presentation. TJ will do the majority of the talking, and in the end, we will leave plenty of room for questions if you have so. So yeah, Peter running Compounding Quality, but the next hour we will talk about dividend stocks. Maybe one first second about Compounding Quality if we go to the next slide. Well, I think that most people, or yeah, obviously, first things first, very important. The most important thing, the disclaimer. I won't bother you with reading everything, but basically what it says is everything we say here is just our personal beliefs and personal views, no investment advice. We try to do the best what we can, but in the end, you need to do your own homework. Now, on the next slide, you can find a brief presentation about Compounding Quality. So started 2 years ago right now to genuinely try to do the right thing and help other investors to, yeah, along their investment journey, basically. And last week, well, something new, something very exciting launched, and that's compounding dividends. Well, for me personally, putting all my time and effort into Compounding Quality, but we found an excellent person who will, yeah, put his heart and soul into compounding dividends, and that's TJ right here. Well, he will talk an hour about dividend investing. I will leave the word to him in a second, and also maybe one last thing from my side to mention. Well, compounding dividends launched last week. Tomorrow, the Compounding Dividends Investable Universe will launch as well. So if you can't wait until the end of the presentation, well, if you go to compoundingdividends.net and click on subscribe there, you can also take a subscription. And then you can see the ETF portfolio. There will be investment cases, courses, and so on. And I think now I will leave the word to the most important person in the room and the best person in the room, someone way more knowledgeable than I am. So, TJ, if you want to go, feel free to do so.
All right, thanks, Peter. Let me advance this slide. So my name's TJ, like Peter said. A little bit about me. I'm a self-taught investor, and I'm really excited to talk to you about buying stocks the same way that you'd buy a local business. So what happened? How did I get here? I'm a partner of Compounding Quality. I had some interesting discussions in the community. Peter and I started talking. He kind of brought up this idea that he was thinking about compounding dividends,
Allô?
and I've been writing there since August.
Oui, mais là, je veux d'abord entendre.
Can go on, Josh, TJ.
Okay. Um, yeah, so I've been there since August. And kind of the reason that I agreed to do this was because I don't think that dividend focused investors have enough quality content. If you look at what's out there, most of it just focuses on the dividend yield and the payout ratio. And I don't think they analyze the business closely enough. I don't think we tend to look at management enough. So I think it can be done better. So like Peter said, the universe is rolling out tomorrow, the first part. It's pretty large, so it'll come in 3 pieces. We're going to roll out a framework for how we analyze dividend stocks. And then once that's out, we're going to start buying companies and building a portfolio. So that's what's in the future. But today, what we're going to talk about is how I got to where I was interested in dividend stocks. I want to walk you through kind of my journey there, because had you asked me about this a year, 2 years, 3 years ago, I would have said, no way. Those are low growth companies. You have to pay taxes. You want to invest in companies that don't pay dividends and get the
You need to
There we go.
unmute. Yeah.
Yep, it wasn't letting me for a sec. But I want to take you through how I got to the place where I was interested in this kind of investing. Then we'll talk a little bit about why those kinds of companies are interesting, how to find them. I'm going to walk you through a few examples, and then I think Peter has a gift at the end for everybody. So first, we'll start with kind of how I got here and my investing journey. Like I said, as a self-taught investor, I started probably the same way most of you did. I read the classic investing canon, The Intelligent Investor, Howard Marks' book. I downloaded the PDF of Margin of Safety. I read Peter Lynch's books. Education of Value Investor was one of my favorites. The Dondo Investor by Monish Pabrai had a pretty big influence on me. I really enjoyed The Joys of Compounding and Richer, Wiser, Happier. There's still, a bunch of books in my to read queue, so I'm always trying to read and learn. But as I went through kind of this classical value investing type canon, I got what Buffett refers to as the inoculation. Now, Peter kind of pointed out to me that as a non-native speaker, this was a unfamiliar word. So I want to dwell on this a little bit and talk about what this means. So Buffett once wrote that value investing is like an inoculation. So it either takes or it doesn't. And when you explain to someone what value investing is, how it works, why, you show them the returns, they either get it or they don't. An inoculation is a vaccine to protect you from disease. And I think learning about value investing helps you understand how to evaluate stocks and how to make good choices. So I think when you get this, it protects you from some of the manias, the panics, the speculation that happens from markets from time to time. And if you think about a vaccine, it also tends to provide long-term immunity. Most things we get the shot once and then you're good. And I think value investing principles are kind of the same way. I think buying companies for less than they're worth will always work. So for me, this idea took. And when I felt like I knew enough, I went out and I started looking for bargains. That happened about where the red arrow is. So if you're not familiar with this chart, this is the CAPE ratio. This is the cyclically adjusted PE. And it's a measure of how expensive or cheap a market is compared to its earnings. This is also known as the Shiller PE. Robert Shiller was the person that came up with this. And basically what you do is you average the earnings over the 10 years, and then you compare that with the price, and it smooths out the ups and downs of the markets. So kind of at the point where I got started, if you look at the history, they didn't look overly cheap, but they really haven't looked cheap since. This doesn't mean that there's not bargains out there. It just means that they're maybe a little bit harder to find. This is Buffett's favorite measure of the price of markets. This is the market cap to GDP. So what this is, it's the market cap of all the companies. This is the US compared to US GDP. Again, same kind of picture. It just shows that things have been going up. This is recent. This came out from JP Morgan. So this is what they call the S&P at inflection points. So if you look right now on a forward PE basis, the only market top that's been higher has been the 2000 bubble, the tech bubble. Right now, the dividend yield is as low as it's ever been. And the 10-year treasury is kind of right in the middle of the range where it's been kind of at these tops. Now, I don't put this up to tell you that a crash is coming. I have no idea. I just think it's interesting to kind of take a view of the market from a few different levels and kind of compare it to history. So this next slide is from the same recent JP Morgan report. The chart on the left is the PE of the MSCI World Index with the US removed. So basically, it's the developed world minus the US market versus the S&P 500. So right now, the difference between the US and the rest of the developed world is 2 standard deviations. And if we look at the all world index PE, it's about at the 20-year average. So what that tells us is this isn't driven by the rest of the world being cheap. It's that the US is more expensive than it typically is. The chart on the right is the dividend yield. It's the same picture. The US about 2 standard deviations more expensive than the rest of the world. Again, the world index ex-US is right at about the 20-year average dividend yield, and the US is below. So that again indicates that that's the US being expensive, not the rest of the world being cheap. So again, all that is not to predict a market crash. It's not to tell you which direction the market is going. It's just to say that if you're a value-based investor, that things are hard right now. And so I made a shift. And the first shift I made was driven kind of by this quote by Charlie Munger. So Munger's answer to hard problems is avoid them. Go out, look for the no-brainers, find the one-foot fences with big rewards on the other side. Kind of like the initial value investing principles, this made a lot of sense to me. So sometimes when you have the conditions that I just showed you on the previous charts and you want to find an idea, or you really want an idea that you've had to work, you start to maybe adjust your criteria a little bit, or you work really hard to force it and to kind of talk yourself into it. And what Munger's saying is that's usually not a good idea. That's usually a mistake. So that was kind of my first shift. I stopped putting so much pressure on myself to find a great idea. I stopped trying to be really smart, and I started trying to find reasons to say no very, very quickly. We know that investing tends to operate on power laws. So a few big winners tend to drive all of the gains. And if we look at Buffett's performance, it's the result of a few great investments he's held over a long period. He has said that his performance mainly is the result of about 12 good decisions. This picture is Monish Pabrai's guess as to what those 12 good decisions are. I don't have a reason to disagree with Monish, so I shamelessly cloned him and stole his picture for this presentation. I hope he's proud. So where to find these kind of no-brainer investments? You can find them during times of market panic, which we really haven't had. You can argue that the COVID crash, maybe, but I think that duration is just as important as how big the drawdown is. And that one happened so quickly. Unless you acted really fast and were really confident, that one was kind of over before we knew it. We can find them during company-specific events. There's been a few of those. You think about Chipotle during the E. coli scare, that share price took quite a tumble. The hard part with these is you have to decide if that event is going to affect the company long-term. And the other challenge is when we're in an expensive market, sometimes the valuation starts so high that even when it comes down, the company doesn't get what I would consider cheap. Recent example, something like Nike. I think in 2021, Nike was trading at like 70 or 80 times earnings. It came down to like 40. They've had some, not great results. Nike's down, I think, somewhere around 20, 25. It's been floating in there for a PE. And if you look at their earnings growth, that's a company that's growing 5, 6, 7, 8% a year. So that's still not something that I would consider overly cheap, even though it's come down a lot from recent highs. And the third place is in unloved and misunderstood industries. There's a few of these around, but again, that can be challenging. And the other part that comes from this is if we do the math on Buffett's 12 good decisions, that's one about every 5 years. So even though this idea makes a lot of sense, these are so rare, then the question becomes, what do we do the rest of the time? If you want a relatively concentrated portfolio of 10 positions, that's going to take you 50 years to get there. And we kind of probably have to assume that we're not going to find ideas as quickly or as often as Buffett does. So it might take even longer. We might get one every 7 years or 10. Cash hasn't yielded anything until recently. We know that not being invested is a pretty big drag on your overall returns. And the longer I invest, the more I've come to appreciate the behavioral side of things, the emotional side. So it's really hard to sit on the sidelines and watch everybody else make money, especially in the kind of market that we've had. So there was one more shift that I had to make to get to dividend and shareholder yield type stocks. And that happened as I was trying to figure out what was going on with this market. Why does it keep going up? Why are investors willing to pay so much more for earnings now than they've been in the past? Is this a new normal? So I started kind of diving into that. And as I looked into this, I found a few investors that I respected that were also talking about the market and how things were getting a little different than they're used to. So the first one was David Einhorn. His theory is kind of that it's related to passive investing. You can see the quote here. He thinks that passive's broken the markets, that no one's looking to see what things are worth, and that's driving prices up. Essentially, the argument is we've lost price discovery. Maybe that's right, but nobody really knows. If 100% of the market were passive, that would be an issue, but that's not where we are. And nobody really knows how much of the market can be passive before you start getting irrational kind of prices or that you lose price discovery. So I think this might be part of it, but I don't think it explains everything. Buffett also made some comments. So he feels like people are gambling. He says for whatever reason, the markets now exhibit casino-like behavior. And when you think about things like the GameStop phenomenon, the NFT bubble we kind of went through, zero-day options, in the US, sports betting is growing right now. If you're so inclined, you can bet on the outcome of our election. When you think about those kind of things, you can sort of see where Buffett's coming from as well. The piece that really tied it together for me, though, came from Cliff Asness. He wrote a paper relatively recently called The Less Efficient Market Hypothesis. If you don't know Cliff, he's got a PhD from the University of Chicago. He's an academic. He does a lot of research, but he also runs AQR, which is a quant fund. In this paper, he talks about the value spreads. That's the difference between cheap and expensive stocks. And he shows that it's been getting more extreme and that it's really not showing signs of closing. So this slide comes right from his paper. This is a blended measure of about 5 different things that we would recognize as valuation measures. So he looks at, I think, PEs in there, price to sales, cash flow yields. He takes kind of a whole amalgamation of those things, puts them together, and comes up with a value spread. There's different ways to calculate it, but everybody's pretty much shows the same thing. And in his paper, he proposed 3 hypotheses. So the first one is the passive investing that David Einhorn brought up. And Cliff basically said the same thing, that we don't know. We don't know how much passive can get into the market before it starts distorting things. Number 2 is low interest rates for a long time. Howard Marks has also talked about this. He talks about, the fact that interest rates are now rising as a sea change in the market. Again, that's one of those maybe, but it probably doesn't explain everything. The most interesting hypothesis that Cliff proposes is the third one, and he thinks that we have technology's effects backwards. So the typical thing to believe is that because you can get information quicker and that it's spread wider, that the market should become more efficient. And it's probably true that more people have more information and that it spreads quicker. But just because there's more information out there and more people have it, that doesn't mean they're necessarily using it rationally. So I think Cliff's idea is that we've confused speed with accuracy. So you can see here, he talks about that an efficient market is going to rely on the wisdom of crowds, right? And any effective market that relies on the wisdom, you need a few things. So if you look into the research on crowd wisdom, there's a couple things you need. One of them is that the members of the crowd have to be independent. The second piece, I didn't put it in the slide, but the second important piece that I think's here is that you need the crowd to all have the same goal. So when you look at these research studies where they do this wisdom of the crowd thing, they're usually something like guess how many marbles are in this jar or guess the weight of this bull. So it's very clear what you're trying to do, and everybody's trying to do the same thing. The markets, I don't think we have that. So you've got fundamental value-based investors, you have technical traders, you have day traders, you have momentum traders, you have hedge funds that their goal is basically to reduce volatility. You've got all these people with all these different time frames, with all these different styles. So I don't think we have the goal the same, but Cliff focuses in on the idea of the independence. So if one idea or one person gets too much influence, the crowd is no longer wise. In fact, it could become a net negative. And you can see his quote at the bottom. Has there ever been a better vehicle for turning a wise, independent crowd into a coordinated, clueless, even dangerous mob than social media? So all that goes into the fact that maybe the reason that the markets are getting more expensive is because they're actually less efficient and less rational, which of course brings me to the question of, if that's true, what as a fundamental value-based investor do you do? The bottom line is, the market looks expensive. It keeps going up. I have no idea if this is a new baseline, if we're going to keep going up, if we're going to trade sideways a while till earnings catch up and we're going to have, somewhat historical returns, if we're going to have crash. I'm just not smart enough to predict any of that. And I have no idea how all of these things have changed the market. So I started wondering, can we invest and neutralize those kind of things? And David Einhorn, again, kind of had the answer. So this comes from his 2023 letter to shareholders. And you can see he said we've become even more disciplined about price and emphasize investments where we get paid by the issuers. So payment can come to us in the form of buybacks, dividends, interest, or in some cases, a takeout from a buyer. He says in here, we don't believe we can reasonably expect securities to be re-rated by investors who are reliably trying to figure out what they're truly worth. Many of our largest holdings are offering double-digit returns directly to investors. So this kind of led to that second shift that I needed to make. What Einhorn's talking about here is really shareholder yield. I had some knowledge about this. I thought it was interesting. At some point, I'd read Meb Faber's book on shareholder yield. Jim O'Shaughnessy had done some research that was interesting that I'd read. So I started kind of digging into this idea even more. So now we can talk about why I think this is interesting. So that's how I got here. Let's talk about why it's interesting. So first is because it's simple. These ideas come from Joel Greenblatt. William Green summarized them really nicely in Richer, Wiser, Happier. The quote on the top here is straight from the Gotham homepage. And Greenblatt says, our investment philosophy is simple, straightforward, and consistent. When you look at Green's summaries of Greenblatt's interviews with him and his idea, he kind of breaks it into 4 points. So one is that you don't need the optimal strategy. You need one that's sensible and that'll meet your goals, that'll get you to where you need to be financially. Number two is the strategy has to be simple and logical because it's not always going to work. We know that every strategy is going to have periods of underperformance. So you need something that you believe in, that makes sense to you, and that you're willing to stick with. We know behavioral biases can really hurt performance, and abandoning something and chasing the hot new strategy can be a bad thing for your returns long term. Points 3 and 4 kind of relate to the idea of not needing to beat the market to have great returns. I think it's Morgan Housel that says that you have below average returns for an above average length of time can still make you rich. And so shareholder yield is a really simple strategy that I think makes a lot of sense. I'm going to mute myself a second because there's a short video here. I'm going to see if it'll work and let Buffett explain to you why.
Well, you don't pick stocks, you pick companies. Yeah, but when I was 11, I picked stocks. I had the whole wrong idea. I thought stocks were things that went up and down, and I charted them. I read books on technical analysis. I read everything. And I thought the important thing was to predict what a stock would do and predict the stock market. And then I read Ben Graham, and I realized that I was doing it exactly the wrong way when I read the book, The Intelligent Investor. And from that point, I never bought another stock. I bought businesses that happened to be publicly traded, but I became an owner of a business, and I did not care whether a stock went up or down the next day or the next week or the next month or the next year. And I didn't have any idea what it would do. I didn't know what the stock market would do, but I knew businesses.
That worked great. Are you still here, TJ? You're still on mute right now. Sounds good.
Am I unmuted?
No, we can hear you. You can go on. Perfect. And the
You
video
can hear me
works
now?
fine.
Okay.
Yes.
All right. Yeah, I tried and it said the host won't let you. So I needed your power to unmute. So ultimately, when we invest for dividends and shareholder yields, we're doing exactly what Buffett was talking about. We're just buying businesses without thinking about what we'll be able to get for them down the road. That's the message Ben Graham and Buffett have been sending for years. And I think that a dividend and shareholder yield strategy is the most fundamental implementation of that idea. So when we look at a public company, We look at it exactly the same way that we would look at buying a business down the road, like a car wash or a coffee shop. We want something that's made money in the past. We want something that's likely to do well in the future. I'm assuming that nobody wants to run the business, so we want good management in place. And then we're going to pay a price that makes sense based on how much cash we'll be able to get out of it. In this strategy, that's your dividends and your buybacks. So that made a lot of sense to me. Beating the market wasn't necessarily my goal when I started to get interested, but it turns out that this strategy does tend to perform really well, especially if you reinvest the cash that you do get out of the business. So this is the price returns of the S&P versus what you'd have if you'd reinvested your dividends. You can see it's a massive difference. So putting that cash to work can make a big, big difference in your returns. We also tend to see that dividend growers outperform over time, especially when you compare them to companies that either don't grow their dividends or don't pay them at all. There's an equal weighted S&P in this slide as well. This shouldn't be a surprise. We know that stock prices do tend to follow earnings, and to grow your dividends, to keep distributing more and more cash to shareholders, you have to grow your profits and your earnings. So that's going to drive the stock price up. Dividend growers tend to fall less in market downturns. I think this really does help you stick to your strategy the way Greenblatt was talking about when times get tough. I think I used to underappreciate this, but considering the research that even passive investors tend to underperform the market because they try and time it, they buy and sell at the wrong times. The fact that your prices don't fall as much, and then you add in the fact that even if the prices are going down, you're getting some kind of positive return from the dividends, it does make these companies easier to hold, and I think that's a big benefit. So on the left, those three bars are during kind of an average down month. The teal bar is your dividend growth companies. The kind of orange one in the middle is high yield companies, and then the purple one is going to be the S&P. The right set of three bars is kind of the worst case scenario. That's the worst 15 months in history for the S&P. You can see that the dividend growth companies still fall less than the market. The high yielders don't perform quite as well in that kind of doomsday scenario. We know good investing is all about the long term. And the longer your time horizon becomes, the more we have to think about inflation. And now that we've actually seen some inflation recently, people are thinking about it. This just shows that dividend growth does tend to outpace inflation. So, the top line rising is the market dividend, the S&P dividends, and then the lower line is CPI, which is the U.S. government's favorite kind of measure of inflation. But we know there's more ways to get capital back than just dividends. So we have to look at everything. Increasingly, companies are using buybacks to return capital to shareholders. So if we want to capture all of that return, we need to consider them. This is the buybacks and dividends of the S&P. The green bars are dividends and the purple bars are buybacks. So you can see buybacks fell off kind of in the great financial crisis of 2008, 2009. But since then, they've been rising much faster than the dividend payments. We do see a little dip there during COVID, but they start to come back relatively quickly. This chart kind of ends in 2021, but this trend has continued. Companies are still buying back shares pretty heavily. So if we take these couple things together, if we take our dividend yield, if we take our buybacks, and then most things also add in a third component, which is debt pay down. When we combine those three things, we get what's called shareholder yield. And this combination tends to do even better than dividends alone. I'm a big fan of this strategy. I think it's a really holistic picture of what companies are returning to shareholders. And it's got some really good benefits. So one, because of the debt pay down and the buybacks, it does tend to be a little more tax efficient than a dividend strategy if you're investing in a taxable account. It gives management some flexibility with those buybacks and debt pay down. They can choose, when to use those, how much, as opposed to a dividend, which is usually pretty rigid. And then those two things, those two additional measures, the buybacks and the debt pay down, those also tend to drive up earnings per share. So the research on this slide is from Jim O'Shaughnessy. Meb Faber is another one that's done a lot of work in this area if you're interested. I was just actually tweeting with Meb, and there's an update to his book on shareholder yield coming out relatively soon. So I'm excited to read that and see the updates. I expect this strategy still performs just as well as it has in the past, but I'm curious to see what that says. So now you know how I got here, you know why it's interesting. Hopefully you're getting excited about it. So let's look at how we can find some stocks to look into and find some ideas. The easiest place to start are pre-made lists. So there's a fair amount of these out there. I'll go through a few, but there's more than just this. The first one of the more common ones, are the dividend aristocrats. So these are S&P 500 stocks that have increased their dividends for at least 25 years. They do have some market cap and liquidity requirements in there as well. There's dividend kings. These companies have 50 years of growth. So they tend to be very large, established companies. That's what the picture on the slide is. You know a lot of these companies. You use a lot of these companies. Coke's on there, Johnson & Johnson, Procter & Gamble, 3M, Target. GPC is the company that distributes auto parts to Napa stores. Like I said, these tend to be very large, very established. We have dividend champions. These are similar to the aristocrats in that they have 25 years of growth, but they don't have any other requirements. So that makes them interesting because there can be some small and mid-cap companies in there. There can be some companies that are maybe too small for the larger institutional investors to get into, and you can find some different things in here. The contenders are companies with 10 to 24 years of growth. Again, no index requirements. So same thing. There can be some smaller companies in here, some less followed things. But in addition to the pre-made lists, we can also screen for companies. So if we're going to do that, we need to think about our goals. And ultimately, we want regular income that's going to grow over time. So we need companies that can survive for a long time and that are going to grow their income. So with that in mind, we can kind of think about some criteria that we might want to set up. For the survival of companies, I like to see lower debt. We know that too much debt can wipe out a company if something unexpected happens. The payout ratio we do need to look at. So that measures how much of the company's earnings go out as a dividend. Simple example, if a company makes $10 and they pay $5 in dividends, that's a 50% payout ratio. A $3 dividend would be a 30% payout ratio. And then we'd like to see a long history of payments. So we know that the company does continue to actually generate more and more cash each year. For growth, we need to see some growth in the revenue and the earnings. If they're going to keep paying us more in dividends, then they need to keep growing sales. We'd like to start with a relatively high yield, which helps us get that compounding going. Doesn't have to be sky high, maybe market yield or higher. We'd like a history of attractive growth in the dividend. So we don't just want to see, token 1% increases all the time. We'd like to see something meaningful there. And then, of course, we have a preference for companies that are in an attractive market or have some kind of secular tailwind that's going to help them continue to grow. So here's some example criteria that I set up. Just a debt to equity ratio lower than 50. I set my payout ratio at less than 60. The current yield on the S&P is about 1.3. So I used 1.5. I used 8% for dividend growth. If we're going to accept a little bit lower starting yield, then we need to see a little bit more in the dividend growth. Those two metrics will play together to ultimately drive long-term returns. And then for revenue growth, I set it at more than 4%. I want to see that at least above inflation. So if we run that screen, here's some of what we get. I just ran it in FinChat. Right at the top, we've got L'Oreal. Terry Smith has called that the best business in the world. BlackRock's on there. That's been a great investment. Accenture PLC's on there. Snap-on Tools is lower on the list. That's been a good performer. So these aren't necessarily just old, stodgy, boring companies. They're just steady growing companies that are returning capital to shareholders in a meaningful way. So we can look at some examples. I'll walk you through a dividend grower, a high yielder, and a shareholder yield company just to kind of show you how they performed and what sort of companies we're looking at here. So Buffett's Coke investment is a good illustration of how a dividend grower can perform. Buffett's held Coke a long time. He bought it in 1988. It was still kind of beaten down from the 1987 crash. And Coke still had some questions around it. If anybody remembers or knows the story about them introducing New Coke that everybody hated, I think that happened 1985 maybe. So we don't know exactly what Buffett paid, but split adjusted, it closed 1988 at $2.79 a share. So that's what I used as a cost basis for the calculations here. The next year, Buffett would have got about 8 cents in dividends per share. So he got about a 2.8% yield. And like I said, he's held it since then. So over the next 36 years, the share price and the dividend payment both grew about 13% a year. So now Coke's close to $70 a share, and Buffett's getting $2 a year in dividends for every share that he owns. I think it's notable and worth pointing out here that the growth rates for the dividends and the share price are the same. They're both about 13%. And actually this morning, just out of curiosity, I went back and I calculated the revenue and the earnings growth for the period. So revenue grew about 5% a year, and your earnings grew about 7% a year during that time. So just something worth pointing out, that dividend growth and the share price, they look very similar, and they're both higher than both earnings and revenue. So Buffett's current yield on his original cost is over 70%. And you can see on the slide, he makes over about $750 million with a B dollars a year from just Coke dividends. That's not bad. Not a bad investment at all. So Altria is my example of a high yielder. If you're not familiar with the company, this is Philip Morris. They split Altria off a few years ago to sell the US tobacco products. They also own a cannabis company. I think they have a stake in AB InBev in beer. And then Philip Morris International is the company that sells the tobacco products in the rest of the world. So Marlboro is the biggest brand. Copenhagen and Skoal are the chewing tobacco brands. Enjoy is their vape brand. They do on tobacco pouches. So interestingly, Altria is the best performing stock in history. It's done 16% a year for the last 98 years. So if you'd invested $1 in 1925, you'd have 2.6 million today for every dollar you invested. Unfortunately, none of us probably did that. So let's look at kind of how the company looks right now. It's got relatively stable revenues. The volume of sales is falling, but the prices are going up. So that's keeping revenue pretty stable. It pays about 8% a year in a dividend, and it's got a payout ratio below 70%. Which is fine in a high yield stock like this. Some things we expect a higher payout ratio. So a slow growing company like Altria, you also tend to see a higher payout ratio in utilities. And then there's a few categories that are required to pay out the majority of earnings to shareholders. REITs, real estate investment trusts, and MLPs, master limited partnerships, are two of those. The MLPs tend to be infrastructure companies like gas and oil pipelines, that sort of thing. So if you had bought Altria 10 years ago, which is probably a more reasonable time frame for us, if you put $10,000 into it and reinvested your dividends, you'd have more than 500 shares today. That would be worth more than $25,000, and you'd be getting about $2,000 a year on dividends. So your yield on your original cost, you're doing 20% a year in dividends now. So my last example is AutoZone. This is our cannibal company, or our shareholder yield company. It's a pretty amazing story, I think. They sell auto parts, oil, maintenance items for cars. They sell it to DIY type folks, and they also sell to auto shops and repair shops. And without paying dividends, this is a 100-bagger. And how they did it was they bought back almost 89% of their shares outstanding over the past 26 years. So you can see the numbers on the slides. They started over 150 million shares. They're down to about 17 million today. They've never paid a dividend, but the stock price has gone from $27 to over 3,000. That's about 113 times increase. They did have some earnings growth, but only about 12 times. So that stock price going up is driven by buybacks, heavily driven by those buybacks. So those are my three examples. I kind of want to wrap this up with a summary of my journey. If you don't recognize the picture, this is a series of drawings of a bull that Picasso did. So frequently we only see that very last one that's very simple, but this is the whole series. And in order, they go from the top to the bottom and left to right. So if you look through them, you can see that Picasso added things and the bull got more complicated. And then it started to get abstracted, and then he removes things. And by the end, the bull is reduced to the simplest form that Picasso can get it, and we still recognize it as a bull. And this is similar to how I think about this investing journey that I've gone on. So I had to make it more complex, and I had to try and struggle with figuring out the markets and studying their history, trying to make a guess about if the future would look like the past, wondering if things had changed, if they had, what they were, what that would mean for my investments. But one of the very first books I read was The Intelligent Investor. And Ben Graham told us that shares are ownerships of a business. They're ownership shares of a business. And after that, the whole journey of making things more complicated and abstract, I've decided to take the market and what it's going to do out of things. And I've come back to what I think is the simplest form that investing can take. And that's just to buy cash flowing businesses for a price that makes sense based on how much they'll pay you. And then you hold the businesses. So as long as the businesses you own are paying you an amount that you're happy with, then those are attractive assets. And it doesn't matter what the market thinks they're worth. You're just going to hold on to them. And we know that being able to do that for a long time and avoiding trading around or trying to time the markets is a big behavioral advantage. And in addition, it's a pretty nice low stress way to go through life. So thanks for your time. I hope you enjoyed my story. I hope you learned something. If you weren't a dividend investor coming in, I hope you at least see the strategy a little differently now. And I think at this point, I'm going to turn it over to Peter, and he's going to play Santa Claus, and he has a gift.
Yeah, perfect. First of all, TJ, I think you did an amazing job, and I don't, give a lot of credits or take someone in the team easily. So you completely deserved it. And most people have their camera turned off, but via this way, an applause, a round of applause for you. And thank you, Boris, for joining me. So TJ is truly amazing. That's also why we decided to do compounding dividends in the first place, because I believe that TJ can do the job. And last week we launched, tomorrow the investable universe for compounding dividends will launch. Everything is new, and that's also why we prepared a special gift for you. And when we go to the next slide right now, well, this is what you can see. So everyone right now would be interested in this. Well, you can get a 30% discount in compounding dividends via the QR code, or just go to compoundingdividends.net/launch. Now, what can you expect basically? Well, you see it on the right hand of the slide. So first and foremost, well, you will get a dividend growth investing portfolio. So real assets will be invested in that portfolio, which is really important. Well, Dixit Charlie Munger, you can see him right here. Show me the incentive and I'll show you the outcome. There also will be an ETF portfolio. If you are interested in attractive ETFs regarding dividend investing, dividend aristocrats, we will look into that for you. There will be deep dives about interesting stocks. So not sure you're going to be mad at me, TJ, for saying this, but for example, a deep dive of Domino's Pizza is in the pipeline. It's an amazing buyback company, and it's funny because Josh and I were looking at it at the same time without really knowing it of each other. So maybe that already tells you something. So there will be deep dives, one-pagers, you will get news report and so on. So basically, well, it's very simple. The goal is very simple. TJ is going to put all his time and effort into dividend investing, into compounding dividends, provide you as much value as you can, and everything will be made available to partners. So you can join via compoundingdividends.net. And right now, we still have 15 minutes left. Josh, I think you can leave this slide open, and I will, obviously, the show is yours. You're way better and way smarter than I am. I already noticed that from talking almost daily over the past few months. So I'll ask you some questions, and I'll be a bit selfish, and have the honor to ask the first question to you. Well, when you look at the space, obviously right now the watch list will roll out. A first buy will be announced shortly. Can you already put some light on some dividend stocks you like right now?
I can. So you mentioned Domino's Pizza already. We both ended up looking into that. I can tell you, I was impressed with the moat that's actually there. You know, it's you wonder, how can a pizza company have a moat? How can it have an advantage? Some of it's the pizza, but most of it's not. There's some really interesting things I found there. I think it's a really interesting company. Some of the story is already out and well known, kind of their use of technology, but I found a few things in there that I have not seen talked about as much. So I think that one's really interesting. I was actually looking at a few REITs. Realty Income looks maybe interesting at this point. It's not as cheap as it was, but that doesn't mean it's expensive. And there's some interesting things happening with debt maturities with some of the other companies. So with the interest rate rises we've seen in the US, a lot of companies refinanced before those started going up. And if we think about commercial loans, a lot of those are going to be coming due. So there may be some interesting opportunities for some of the larger REITs that are more well financed and in a better position. So I'm looking into a few of those. I'm kicking around a few of the oil companies. Question on the cyclicality with them, but there's a few of those that look interesting. And that's an area where I have some personal knowledge. I actually come from a family that, not myself, but my father and my grandfather, all in the oil industry. So there's a lot of people that I can pick brains, and I know more than I probably care to already about the oil industry. So there's a few of those energy type companies that are looking interesting. What else? Unum Group is one that I'm looking at. They're similar to like an Aflac. They do like workers' comp benefits. Research is not done there, but they have some interesting numbers. They've done some good growth. The dividend yield's decent, and they're buying back shares. And from what I can tell so far, I seem to like management. So those are a few of what I'm looking into. There's a list that I've started some research on. There's a whole bunch that I've said no to. So I do still keep that say no quickly kind of mentality. I try and filter out as much as I can to just get to the things that might be interesting.
That's lovely. Next question, or we got a few questions in the chat. By the way, feel free to ask your question via people in Zoom can just use the chat function there. Same for people following on YouTube. So question from Rotimi, which basically asks, well, obviously you have the dividend growth companies, and then you also have some high yield companies with a higher dividend yield, but with less room for growth. Well, what do you prefer in general? Which kind of companies do you want to look at and build your portfolio with?
Yeah, that's a good question. I think both can be interesting, but the longer term you look, the more interesting the dividend growth companies become. If we look at the historical performance of dividend stocks, you want ideally both. If you can start with a high yield and then get an attractive dividend growth, you do very, very well. And so the way this kind of plays into that idea of the no-brainers and the company-specific events. One of the ways to do this is to find those companies that are maybe going through something temporary, or maybe it's one of those cyclical energy type companies that is at a low. If we can buy them there where you're starting with a higher yield, and then we're going to continue to see decent growth off that can be attractive. So ideally, a blend of both, but I tend to lean more towards the dividend growth companies in the long run. That dividend growth tends to drive more of the yield or more of the return than your starting yield.
Makes sense. Next question from Boris, and Boris is a very active member or partner of Compounding Qualities. So By the way, we recently interviewed Boris, and it will also be made available shortly. So we can all also learn a lot from him. But his question to you, TJ, well, are there certain industries or sectors you avoid due to the cyclical nature of the business activity? For example, do you avoid banks or not at all?
I try not to say no to entire sectors or types of companies from the get go. And by the way, Boris, it's nice to put a face to the name. I'm glad you came. But there are certain companies that I think are much harder for me to figure out. Examples, pharmaceutical companies, I have a hard time with. And honestly, there's certain industries, they're not probably not so much dividend payers, but there are certain things that just bore me whenever I started looking into them. So I tried to look at cybersecurity companies like, I'm blanking, Arista Networks and a few of those, and I just got really bored trying to figure out cybersecurity. And I figure if I'm too bored to read the stuff, that's probably an indication that I'm not going to figure out the company well enough to make an investment. Cyclicality tends not to bother me, but you do have to be willing to sit through it. I think dividends can help with that when you're getting that positive return. And you have to really understand the long-term story as to why this industry is going to come back. Banks, the hard thing for me with banks is the moat, right? Like, what advantage does one bank have over another outside of the big, huge ones like your JP Morgans and your Goldman Sachs? Some of these lists have a lot of regional banks and a lot of smaller banks. And unless they do something very specific, unless they have a real maybe niche that they're in, the part that's hard for me on those is what's the advantage? Why are they going to keep growing? Why aren't they just going to get swallowed up by some other banking company? So there's industries that are more challenging for me. There's certain industries that maybe are too hard for me, but I try not to say no right off the top. And like I said, cyclicality doesn't bother me. Actually, I think if you're willing to buy some things that look really ugly and that everybody hates, I think you can do well in some of the cyclical companies.
Makes a lot of sense. Small question from Vipul. Well, you see the 30% discount on the screen here. Well, is this for 1 year or for lifetime? I'll take this one if you don't mind, TJ. Well, answer is it's for 1 year. If you are a partner of Compounding Quality already, it's for life. So by the way, if you have a certain question or something like that, feel free to always email us via compoundingquality@gmail.com. And if you receive an email for compounding dividends, if you just hit the reply button via the service provider you're using, well, it will always come at us and we will always answer. So always happy to help. We also got an interesting question on YouTube from Mal, if I pronounce it correctly. And it's interesting because we also discussed that, TJ. Well, when you look at dividend universe, it's quite large, right? So you can have hundreds of companies basically that pay an attractive dividend yield. Well, how do you start there? How out of the hundreds of stocks, how do you get to try and find the most interesting ones?
Yeah, so I could try and drive a lot of subscriptions and say that answer comes in Saturday's article, but but because people showed up, I'll give some of that away. So one thing, there's several different ways that I do it. One way, just sometimes comes through the news. Sometimes you see a company that reports a bad quarter or something, and the stock price takes a giant nosedive, and you know that they're an interesting dividend company. I'll go look at that right away and try and figure that out. But if you have that list sitting in front of you, one of my favorite things to do is just to sort it by different things. If you're using Excel, you can sort by dividend yield and you can find the ones that have the highest yield. You can sort by dividend growth and you can look at the high growers. You can sort it by, if you have a debt to equity, you can sort it by that and find the companies that have really strong balance sheets. And what you can do is just kind of take a look at those. And when you see the same name coming up over and over and over again, that's usually a good indication that maybe that's something to take a look at. It's towards the top in yield, it's growing well, it's got a decent balance sheet. That might be something worth looking at. Another way that I'll sometimes do it is if I have companies that I think are interesting, I'll look at historical yield versus what they sell for right now. And sometimes that can tell you if they're maybe getting interesting in price. If typically they've yielded 2% and they're selling at like 0.95, that tells you it's probably expensive. But if they're typically a below 1% yielder and they're yielding 2 right now, that might be interesting. They're cheap for some reason. And the question is always, why are they cheap?
Makes a lot of sense. From a gut feeling, if you could choose, would you in general prefer the dividend growth stocks or more the cannibal stocks? And maybe a small add-on question, let me scroll quickly, from someone in the chat who asked, well, when should a company basically buy back shares? For example, when it has a lot of debt on the balance sheet, well, should they consider buying back shares?
All right, so I'll take that in a couple parts, I guess. Preference, I like a blend, honestly. I like some dividend yield because you're getting that cash, and I like that you can reinvest that and own more of the company. But I do like some buybacks. So like I said, I really like a company that uses a blend. Especially there's some companies out there that tend to pay a dividend yield, and then you'll see them do a big buyback when the shares get cheap. I really like those ones that are opportunistic. And that kind of rolls into the second part of the question, which is when should a company buy back shares? I mean, the easy answer there is when management thinks they're undervalued. And as far as debt on the balance sheet versus the buybacks, that's very dependent on a few factors. So, the question is, does that debt become mature? What's the interest rate on it? Is it floating? Is it fixed? What do you think how undervalued do you think those shares are? And that's one of those decisions that you have to trust management on. And that's one of the reasons I think looking at management is so important, because they're the ones that are going to make that choice.
Interesting, thank you. Another one that came in, well, it's a hard one. If you don't want to answer it, feel free to just say so. When we
No, give me
talk
the hard one.
about the dividend growth or the expected dividend growth for the portfolio you're going to build, what would be satisfactory according to you? What kind of dividend growth would you like to achieve for your portfolio?
Oh, that is a good question. That's a hard one. Overall, portfolio-wide, obviously it's got to be above inflation, right? So we know inflation tends to run 2-3%, so we need something above that. Minimum, I would like probably double that, so maybe 6%, but higher is better. And again, some of this is going to be dictated by the market. What becomes interesting? What does the market put on sale? What are we able to get for a reasonable price? But somewhere 6% or higher portfolio wide would make me probably pretty happy. But again, it's going to depend on the starting yield for some of those companies. If we can get 1.5% yield and 12% dividend growth or 15% dividend growth a year, and it looks like that's going to continue, that's pretty attractive. And if we can get 8 or 10% yield right now, and we can get 5% growth on that, that's not a bad outcome either.
Yeah, exactly. Maybe a last one, because we are approaching 1 hour here. Well, a question from Miguel. If you want to look at the historical dividend growth of a company over the past 10 years, well, how can you find it?
Yeah, the easiest way for me is FinChat. Honestly, it's right on the front page if you use FinChat. They give you dividend growth, I think, for 2 or 3 years, 5 years, and 10 years. And then they actually provide a projected forward growth as well. So that front page, whenever you use FinChat to look at companies, has a decent amount of information. You can actually find the debt to equities right on there, the dividend growth, revenue growth is on there, EPS growth. So that's the easiest way to find it for me.
Yeah, maybe one final one, because this is an interesting one. Jeremy Bassam. Well, once the portfolio is established, so you have a fully invested portfolio, are you planning to use dollar cost averaging to keep adding to your positions, or how do you look at that?
That's again probably market dependent, but assuming nothing changes, yeah, I would probably dollar cost average in. And whenever I had something, when I had a sum to invest, I tend to be one that I kind of look and see what's the most attractive thing right now, and I'll put that in. I was thinking about this earlier, and Peter, we haven't talked about it, but right now, as far as the dividends, I'm leaning towards just automatic reinvestment into the company that they came from. I played around with the idea of letting them build up in the account as cash and then saying, oh, this position we have is the most attractive. Let's put all the dividends towards that one. But honestly, I think that, we tend to be bad market timers, and that probably just letting the company grow and reinvest the dividends where it came from in an automatic fashion is probably going to end up in the long term giving us the best results, and it's the easiest thing to do.
This is beautiful. Brian also asked, well, will there be a replay available? Yes, it will be. So basically, if you just go to the YouTube of Compounding Quality, probably even 1 minute after we ended this one, you will be able to rewatch it, and we will also send something out. So yeah, if someone's question hasn't been answered here, feel free to reach out via email to us. We always try to help. And yeah, this way, I just want to sincerely thank TJ. I think he's doing an amazing job. He's doing beautiful, and I hope his hard work will be rewarded as well. So hopefully we can welcome some of you as a partner of Compounding Dividends. And well, the slogan is one dividend at a time, right? So we will try to achieve that. And all the respect to you, TJ. Not sure if you have any last words here, and then we will, round the meeting here.
No, I think just, thank you for the attention. Thanks for the time. Thanks for the good questions. And like Peter said, we're going to work hard on this and hopefully produce some really good results. So hopefully some of you will come along as partners, and we'll see where this goes.
Okay, perfect. Thank you, everyone. Have a lovely weekend already, and love to see you on the other side. So thank you, and have a lovely day.